instead of buying it yourself and maintaining it yourself, you feel that another company might be in a better position with lower costs of capital and maintenance, so you just rent it from them. There could also be the case of licensing, where, for example, you get access to an intangible asset like a brand name or a patented formula. So, let's say you might want to sell Coca Cola in a remote region, in an island somewhere where Coke doesn't have their presence, and then you can tell them that, okay, I will sell Coke over there, and you will provide me your name and your formula. Franchising is similar to licensing, but it's not just the name that the licensee gives, right? It is a more comprehensive form of licensing where they not only give the name but also some marketing support and other support in terms of how to go about doing the business. Now, all this comes together in a value proposition. So the who, that is the customers, the what, which is the product or service, the where, which is the geographical and the customer and the market segmentation, and then the how much, right? So all of this comes together. And then what we have is a value proposition that, okay, so this is the product and this is like the support and service that goes with it. This is the process of how it is actually sold. And then what is your competitive advantage compared to your pricing with vis-a-vis your competitors. So again, if we talk about Tesla, their electric car value proposition has lots of small value proposition parts, right? So obviously the electric propulsion system is one part where zero emissions is good for the environment, and then obviously the low cost of fuel, and then again performance, strong, silent, and then of course there's some technology advantages as well in terms of the self-driving capabilities, and then of course they've got these software upgrades going on. And later on I'm going to talk about network effect. So it's just that what that means is, as more and more people become Tesla users, their network kind of gets strong. So think about like Facebook or WhatsApp. I mean, why are we on Facebook? Or why do we use WhatsApp? Is because our friends and family and our colleagues, they use it, right? So it's easier to communicate. So just like that, there is a network effect, and we'll talk about that in more detail later on. But for now, how does this company deliver the value proposition? So, okay, we already talked about what is a value proposition, but how the firm actually delivers that value in terms of their value chain, right? So who are the people and what are the assets that are involved in this delivery? And these assets or these people, so the assets, are they owned? Are the people in the company, or are they rented or outsourced? So this is like serious analysis now. That, okay, now you've understood what the business is, what their value proposition is, and now you're really getting into their value chain. That, okay, so how do you actually deliver this? And are the assets owned or they rented? Are the people in-house or are they outsourced? So this brings me to the value chain, and very, very important here is that this is one firm. So we are talking about within a firm, not like a supply chain which is across multiple companies. This is by a single firm, how it carries out these activities and how the value is added to each activity and what does it cost adding that value. So naturally we're interested in the profit this company is making, and can it continue to do this forever and ever in terms of its competitive advantage compared to other companies. So very interesting concept. I think it was Warren Buffett who actually came up with this concept of economic mode. So let's say there is a castle here, and I'm very bad at drawing, but let's say this is a castle, and along the castle you have this moat. Remember like how we used to have in the castles, where there used to be like this water around the castle so that any armies that are coming to attack could not reach the castle because there was this moat protecting the castle. And think about it in terms of an economic moat that if another competitor is trying to come in and copy your value chain and try to give the same value proposition to your customers, how they will not be able to do it is if you have like a competitive advantage. And think about WhatsApp. Like, I mean, if somebody wants to kind of start another WhatsApp, it's like going to be difficult for them, right? Because everybody's already on WhatsApp, or think about Facebook. So this is what you have is as an economic moat, and that is what is your competitive advantage. Now, last part of this video, and then we'll move on to the next one, in which we talk about the types of business models and their financial implications, and then the last one where we'll talk about the risks. But let me just wrap this up first. So again, in terms of the business, you need to understand how the revenue and profit is being generated, right? And this is what we call unit economics, that per person or per customer or per product or per unit, right? I mean, how is this actually happening in terms of the revenue and the cost? So where are the revenues coming from? And what is the cost for each of those revenues coming in? So let's look at a very simple example. So there's a producer of bottle caps, and they're selling each cap for 2.5 cents. So this is the selling price, right? And what's happening, that each of those products, there is some material and labor going into that, which is costing you 2 cents. So 2.5 is the selling price, 2 is your variable cost. So this is known as variable cost. And why variable? So the word variable is that basically as your units go up, the cost goes up. It varies with the amount of units. That's why it's known as the variable cost. And when you subtract those two, what you have left is what we call the contribution margin. And why we use the word contribution margin is because every product, when it's sold, it contributes this much towards covering the fixed costs of the company. So every time a bottle cap is sold for 2.5, 2 cents of that is going straight towards the direct material and labor that was used to produce that, right? So that is gone. And then the remaining 0.5 is the contribution margin, which is being contributed towards covering these fixed costs. So if you have fixed costs of $500,000 and one bottle cap contributes 0.5 towards covering this this fixed cost, so how many bottle caps do you need to sell? And it's kind of straightforward, right? Because you just have to calculate the number of caps, and one is giving you $0.50, then you naturally need to sell 1 million units to actually, well, not just 1 million, because this is in cents actually. So this is not even US dollars, this is in cents. So when we say 0.5, this is not dollars, it's in cents. So in dollars, it will be 0.005, right? And because it's half a cent, and you'll have to sell 100 million of these bottle caps to cover your 500,000 US dollar fixed cost. So I hope you get the point here. Okay, next, you have a restaurant chain, average order €50. Ingredient costs. So again, this ingredients is the variable cost. They cost 50% of sale. So every time you're selling this, this is the price, right? 50. So your variable cost will be €25 because of the 50% of sales. And that means your contribution margin is €25 as well. Now your fixed costs are 250,000. And if you are, every time you sell, you make $25. 25 is contributed towards covering these costs. So you will need to sell 10,000 orders. You will have to have 10,000 for your break even. So when they say what is the firm's unit break even point, the answer here is 10,000. And then what will be the operating margin at 20,000? So let's say you're not having 10,000, you're having 20,000 orders. And for each order, you're making 25 euros contribution margin. So what is the total contribution you are making? So that will be 500,000. Yeah, 500,000. And then 500,000 minus the fixed costs of 250,000. So this comes to 500,000. This is our contribution margin for the whole business. And then you minus this 250,000 fixed costs. So it will be 500,000 minus 250,000. And you are left with an operating margin of 250,000 at 20,000 orders per year. So at 20,000 orders per year, this is the operating margin that you will have.